$7 trillion.
It's a number that it almost doesn't feel real. It's hard to even think about.
I was sitting here just before we started trying to find an analogy for it, you
Yeah.
know? And I honestly couldn't. $7 trillion isn't just a bad day. It's a global event. To see that much value just evaporate from the precious metals markets in what, 36 hours?
36 hours, yeah. And that's just the start. If you zoom out just a little bit more, you pull in this stock market that got dragged down with it, and we're talking over $10 trillion.
10 trillion?
Gone. Wiped off the global balance sheet in 2 days.
Wow.
I mean, we just witnessed a demolition.
And, usually when you see a number like that, the story is pretty straightforward. The bubble popped, right? Or the economy's rolling over.
Yeah.
But I've been staring at the data we pulled for today, specifically the physical silver data. And I have to say, this might be the strangest signal I've ever seen.
It is a paradox. There's no other word for it.
We have this historic price crash, a crash that rivals the Great Depression, happening at the exact same moment that physical demand for the actual metal is just exploding.
Right.
So our mission today is to figure out, well, which one is real? Is the price on the screen the truth? Or is it the physical bars moving around in vaults? Because they can't both be right.
Exactly. One of them is a lie. And in finance, we're always taught the price is the ultimate truth. But I think today, the data is going to show us the price is, well, it's a fiction right now.
Okay, so let's start at the crime scene. We need to map out the damage because 10 trillion it's just an abstract concept. What exactly happened on the charts?
It was a slaughter. There's really no other way to put it. You saw silver just fall off a cliff, down 30%. It crashed right through $85 an ounce.
And that alone was what, almost 2 trillion?
Just under $2 trillion in market cap. Gone. Just for silver.
And this wasn't a slow bleed over a week. This was
vertical. Absolutely vertical. The technicians are calling it the red candle of death.
Hey, that's colorful. But looking at the chart, it's not wrong. It is just one giant solid red bar going straight down. I was looking at the history on this, and for silver, this was the single worst day since 1921.
1921. Just think about that for a second.
So over a century ago. So we just lived through a crash worse than anything in 2008, worse than the dot-com bust, worse than Black Monday. We had to go back 103 years to find a day this bad.
A 103-year record broken in one session. And it wasn't just silver. Gold got hit hard, too, down almost 14%, broke below 4,900. Platinum down 27. Palladium down over 21. It was a total liquidation of everything.
And just to put that $10 trillion number in perspective for everyone listening, because our brains kind of shut off after a certain number of zeros, that's more than the annual GDP of every country on Earth except for the U.S. and China.
That really drives it home.
We basically deleted, what, 2.5 UKs? Or the entire economies of Japan and India combined? Just poof, gone in 48 hours.
And it was the speed of it. Silver had a 35% drop from its high to its low within the day. That's the largest intraday swing in history.
So if I'm just a casual observer looking at a screen, my conclusion is simple. The bull market's over. Everyone is dumping silver. The party's done.
That is the only logical conclusion you could draw from the price.
But this is where it gets weird. We have to talk about something called first notice day, because that data completely contradicts the idea that nobody wants this metal.
Right. This is the big twist. While the price was imploding on screen, the internal plumbing of the market was screaming that there's actually a shortage.
Okay, so walk us through first notice day. For anyone who isn't a futures trader, why is this one day so important?
So most of the time, the futures market is just a betting platform. People are betting on the price, but they never, ever intend to actually get a bar of silver.
You just settle up in cash.
Exactly. But first notice day is the moment of truth. It's the deadline where the exchange basically says, okay, time's up. If you're still holding a contract to buy, you have to pay up and tell us where to ship the metal.
So the paper bet becomes a real physical delivery.
Precisely. And what we saw for the February silver contracts was, well, it was stunning. We saw 9.4 million ounces worth of delivery notices issued.
9.4 million ounces. That's a huge amount of physical silver.
It's massive.
Yeah.
But the most critical part is the timing. This huge demand for physical happened before the crash.
So this wasn't people buying the dip. This was big players demanding the physical metal while the price was still high.
Yes, exactly. If the market was weak, you'd see people selling those contracts, right, getting out. Instead, we saw a rush to secure the metal. And look at who was doing it.
Yeah, I saw the names. Wells Fargo, JP Morgan. These aren't small-time players.
This is the smart money, and they were scrambling.
Yeah.
Wells Fargo issued over 7,000 notices. But then you look at who was taking delivery. JP Morgan stopped, 487 notices. Macquarie stopped 533.
And just to be clear, stopping a notice means you're the one getting the metal, right? The lingo's a little backwards.
Correct. You're catching the delivery. So you've got the biggest banks in the world playing this frantic game of musical chairs, trying to source and deliver silver at the exact same moment the public price is getting obliterated.
This is a total disconnect. On one hand, you have the price collapsing 30%. On the other, you have banks sweating to find 9.4 million ounces of actual bars.
And that brings us to maybe the weirdest stat of all. Despite the red candle of death, despite the worst day in a century, silver actually finished the month up 19%.
How is that even possible? How do you crash 30% but end the month green?
Because the buying pressure leading up to it was just that strong. We had 9 straight months of gains. The trend was a freight train. So this one catastrophic day happened inside a monthly trend that's still technically up.
So you ran a marathon, tripped, and face-planted 10 feet from the finish line.
But you were so far ahead, you still won the race. Yeah.
Yeah.
But you definitely broke your nose in the process. The damage to traders was very, very real.
Okay, so let's talk about the evidence for this being a manufactured event. Because if the U.S. price is fake, usually you see that reflected in the international markets. And that brings us to China.
The Shanghai Premium. This right here is the smoking gun.
Right. So in New York, on the COMEX, the paper price closed around $85 an ounce.
85, yeah.
But at the same time, in Shanghai, what's the price for physical silver?
It's trading right around $122.
Wait, that's a $37 difference.
It's a 43.5% premium.
That shouldn't be possible. I mean, in a normal world, people would just buy silver in New York for 85, fly it to Shanghai, sell it for 122, and make a fortune. The fact that gap exists tells you something is broken.
It tells you the metal isn't available at that price. You can't just buy it and ship it. But here's the really telling part. Normally, in a crash, premiums get crushed.
Yeah, because sellers are panicking, trying to unload what they have.
Exactly. So the local price should have crashed too. But it didn't. The U.S. price collapsed, and buyers in China just shrugged. They held the price at 122. They didn't lower their bid one bit.
They're basically looking at the New York price and saying, we don't believe you. Your computer is lying. We know what this stuff is actually worth.
It is a complete and total rejection of the COMEX price. They're treating it like noise while they drain the world of physical supply. Which leads us to the theory of what this really was.
The paper slaughter.
The paper slaughter. It sounds dramatic, but the mechanics make sense.
Okay, unpack that. Why would the big players want to crash the price if they're also the ones scrambling to get the physical metal? It seems counterintuitive.
It's all about leverage. For 9 months, the price was going up, so traders, they get confident. They start borrowing money to buy more and more paper contracts. We call them the weak hands.
Because one little dip, and they get a margin call and are forced to sell.
That's it. And the big banks, they can see all those orders. They know exactly where the breaking point is. They know if they can just push the price down hard enough, they can trigger a cascade of forced selling.
A domino effect.
Yes. The theory is the system was getting dangerously close to a physical squeeze.
A squeeze meaning they were about to literally run out of silver to deliver.
Potentially, yes. Inventories were draining. That 9.4 million ounce delivery demand was huge. If that continued, the COMEX might have actually defaulted.
And if they can't deliver the silver they promised?
The whole system breaks. The price goes parabolic. So to stop the system from breaking upwards, they broke it downwards. They triggered a paper crash to shake out all the leveraged speculators and buy themselves some time.
It's a reset, a violent one.
A very violent reset. But notice what didn't change. Did a giant new silver mine magically appear?
No.
Did the solar and EV industries suddenly stop needing silver?
No, that demand is red hot. The fundamentals are still the same.
The fundamentals are identical. The only thing that changed was the amount of leverage in the paper game.
But you can't just crash a market that hard without some kind of catalyst. You need a headline, a reason for the panic.
And they got the perfect one. The looming U.S. government shutdown.
Which is set for tomorrow, January 31st.
And the betting markets, like Polymarket, are pricing it at an 85% chance of happening.
We see this political drama all the time, but why is this one hitting the markets so hard?
I think everyone's remembering the last big one. In 2025.
That was the long one, yeah.
43 days. It knocked almost 3% off of GDP, cost about $34 billion. It's a real economic shock. It freezes up liquidity.
So explain this, because the question I get all the time. If the government is in chaos, shouldn't a safe haven like gold or silver go up?
Eventually, yes, but not first.
What happens first?
A liquidity crunch. When panic hits, cash is king. A big fund manager facing uncertainty doesn't buy gold. They sell whatever they can to raise cash.
They sell their winners, they sell their losers, they just sell.
They treat their gold and silver position like an ATM. They cash it in to cover other problems. We saw the exact same thing in 2008. Gold crashed right alongside stocks at first.
And then what happened?
And then the Fed steps in. They see the chaos, they panic, and they print money to fix the mess. And that is when the metals take off like a rocket.
So the pattern is fear, then a liquidity-driven crash like we just saw, and that's followed by stimulus, which leads to the real rally.
That's the historical playbook. The crash is what sets the stage for the spike.
Which brings us to the meat grinder, because knowing the playbook doesn't really help the person who just got wiped out.
Yeah, it's absolutely devastating. We have to be clear on that. If you were a short-term trader using any kind of leverage, this week was probably a catastrophe for you.
That red candle of death isn't just a line on a chart. It's real people's accounts getting liquidated.
It's a nightmare. And from a pure technical standpoint, the chart looks broken. It signals extreme danger in the short term.
So you really have two totally different groups of people looking at this, and they're seeing opposite realities.
You have the trader and you have the stacker.
The trader is in full-blown panic mode. They see the technical damage, the broken chart. But the stacker, the long-term physical buyer, what are they thinking right now?
They're probably relaxed, maybe even smiling.
Why? Their silver is worth less on paper, too.
Because they're not looking at the $85 paper price. They're looking at the $122 Shanghai price. They see the physical demand. To them, a paper price drop isn't a loss, it's a sale.
It's a discount, an opportunity to buy more real metal using a fake price.
Exactly. If you own the asset outright with no leverage, these price drops are a gift. They know the paper market is lying, and they're using that lie to their advantage.
It really just goes to show you the danger of leverage. The market can stay irrational a lot longer than you can stay solvent.
That is the brutal lesson of the past 36 hours.
Okay, so let's tie this all together. We are at this incredible crossroads. We have a $7 trillion crash, a 103-year record for the worst day in silver.
But at the same time, we have nearly 10 million ounces of physical delivery demand surging into that crash.
We have China paying a 43% premium for the real thing, essentially ignoring the New York price.
And we have a government shutdown coming tomorrow that both explains the initial panic and sets the stage for the money printing that always follows the panic.
It's a war between the paper reality on the screen and the physical reality in the vaults.
And in the long run, physical reality always wins. You can create $1 trillion of paper silver contracts with a few keystrokes to smash a price. You can't create a single ounce of real silver.
That's the bottom line. You have to dig it out of the ground.
But you can definitely scare people into selling you their real metal at a fake low price. And that seems to be what just happened.
So here's the thought I want to leave everyone with tonight. It feels like a high-stakes game of chicken. We have this government shutdown coming. We know the first reaction is always a flight to cash, which means selling assets. But what happens if the physical inventories actually hit zero while the paper price is still down here?
That's the trillion-dollar question, isn't it? If the physical runs out, the price isn't set in New York anymore, it's set in Shanghai. And if that's the case, the snapback from $85 wouldn't just be a rally. It would be a violent, shocking repricing of what's real.
Does the paper tail keep wagging the physical dog, or does the physical dog finally turn around and bite? We are about to find out. Thanks for diving in with us.
Stay safe out there. It's going to be a wild ride.